Assalamualaikum and welcome to the Tax News at 1:30, especially to our lecturer, Madam Wahyu Yusof. So today, my team and I, Abdul Basit Mustafa, will be presenting a few selected issues in the topic of tax planning. Our tax news today will be discover several issues regarding the tax implication, treatments, and incentive. So the first issue is what is the best type of company for the purpose of expansion to set it up in Malaysia?
Is it a subsidiary company?
Or a branch office?
Oops, before we go to the conclusion, let's take a look at the comparisons. Subsidiary company will be taxed as a Malaysian tax resident entity and the local tax benefit is available. But for the branch office, it will be taxed as a non-resident entity and the local tax benefit is not available. The tax incentive may be available for subsidiary company, depending on the type of activity undertaken and subject to meeting the condition. But for branch office, general incentive is not available. In the context of a subsidiary company, the SME is subject to income tax at the rate of 20% on the first 500,000 chargeable income, followed by the 25% for the net chargeable income. And for the branch office, it is subject to the tax rate at 25% on the profit to the branch. And not to forget, the withholding tax of 10% plus 3% is applicable on the payment made to the branch for the service that performed in the Malaysia. Lastly, for allowed activities, subsidiary can conduct all the business activities, but branch office, it must be the same as the parent company. So that, with all the comparison, we can conclude that it is advisable to setting up a subsidiary in Malaysia since it has a less restriction compared to the branch office. That's all from me. Let me pass to the next issue to my team.
Next issue is, do companies have tax incentives to claim to reduce tax liability after 5 years of commencement?
Is there any tax incentive?
Yes, under Schedule 7 of the Income Tax Act 1967, there is tax incentive offered for company that commence after 5 years, which is called the reinvestment allowance. Reinvestment allowance is also commonly known as the second round incentive for companies which had received the tax holiday of pioneer status or investment tax allowance. Reinvestment allowance is available to manufacturing company and also agriculture project company. RA will be available for companies which have been in operations for at least 36 months. RA is used to reduce up to 70% of statutory income of the company from its business source in respect of the qualifying project. Any unused RA may be carried forward to set off against the future business income in the post-RA period. The unutilized RA at the end of the RA period are allowed to be carried forward up to maximum period of 7 consecutive years of assessment only. The incentive period for RA is 15 years from the first year claimed by the company.
On the other hand, issue number 3 is about what is the ideal date to dispose an asset.
Is it after 2 years of usage or even more?
The answer is, according to Para 71 Schedule 3, the timing of sale is crucial to avoid the clawback of capital allowance of the asset, as at least minimum 2 years of ownership is needed. So, the company's capital allowance for the asset will be treated under normal balancing adjustment. It can be either balancing allowance, which should be disposed of at year end instead of following year in order to obtain balancing allowance to shelter adjusted income, or balancing charge, which should be postponed to the following year instead of disposal at year end in order to defer tax liability.
Furthermore, the next issue is about what are the criteria of company to claim the group relief.
Is there any benefit of group relief towards the company?
Okay, in order for company to claim the group relief, they must meet all the 7 criteria. For the first one is it must be incorporated in Malaysia and a resident in Malaysia in the basis year for the year of assessments. The company should be a related company throughout the basis period and the 12 months period immediately preceding the basis period. Company also must have a paid-up capital in respect of ordinary share of more than 2.5 million at the beginning of that basis period. The company must have a 12-month basis period ending at the same date, and also make unchangeable election to surrender or claim an amount of adjusted loss in written form furnished for the year of assessment in this Section 77A of the Income Tax Act, and it is subject to tax at the appropriate rate as specified in the paragraph 2 of Part 1 of Schedule 1 of the Income Tax Act.
But what is related companies?
Oh, related company as defined in the Income Tax Act 1967 is the company own at least 70% of the ordinary share capital of the other company, or a third company owns at least 70% of each of the companies, and the holder of the ordinary share are entitled to at least 70% of the profits and asset of the company on winding up.
The benefits of the group relief is a mechanism that allows a member of corporation tax loss group relief to share the benefit of certain corporation tax losses. One member of the group can surrender these losses to another members of the group, which can deduct the loss from its total profits, thus reducing the amount of corporation tax payable. In other words, the claimant company may escape from tax liability as the adjusted loss for the surrendering companies may transfer to claimant companies, and it is restricted to 70%.
Not to mention, one of the issues that we discover is when a company wants to purchase an asset but indecisive to decide which method to pay.
Is it better to finance by cash or through a loan?
How about a finance through a hire purchase, or maybe through leasing?
In my opinion, there are two situations to determine which method is the best. Firstly, if the company has excess income, it is advisable to purchase it by cash because the company can claim capital allowance based on the full cost of the qualifying asset. Next, the company would be entitled to claim initial allowance and annual allowance. The second situation is when the business has a current year business loss. It is advisable to make an acquisition through leasing since the leasing charges will increase the adjusted loss. The current year business loss will be allowed to shelter other income in the current year at the aggregate income level.
Last but not least, there is issue about which method of acquisition company is actually preferable.
Purchase by acquiring the company asset
Or by acquiring the company's share?
We actually do prefer acquisition by shares because accumulated tax losses and unabsorbed capital allowance can be carried forward for 7 consecutive years, and it can be set off against future business income to reduce the tax liability. If purchased by acquisition of assets, the accumulated tax losses or unabsorbed capital allowance will unlikely to be transferred to the acquiring company, and any tax exemption or incentives that are enjoyed by the target company cannot be transferred to the acquiring company. Therefore, the acquiring company cannot enjoy the ability to reduce their tax liability.
That is all from us. Tax News 130 till we meet again. Thank you.